Kalimeranthropos. Hello everybody. Welcome to O Economica, all about economics. Yes, back again, back with you, back in time, brand new episode. What are we talking about today? No, I'm not talking about anything. I'm showing you a well-defined and precise research that I made about the US Treasury yield curve. And I'm going to show you what are the real numbers. So right now you can choose blue pill to stay in the real world as they told it is and just carry on. You can choose red pill, and I will show you the truth about the United States so-called balance of trade deficit, and I will show you the truth how the whole global community finances the United States. And so probably we should start to ask our money back from the United States. And we can start right here, right now, with this on this page. We have the official data, which are dated back to June 2024, and just released on February 2025. And as you all can read in English, and I will read it again. So these are the total holdings of US assets worldwide. So you can see there are four columns: equities, long-term debt, short-term debt. And the amounts are basically divided by country or region. So as you all can see, for example, let's start with A as Australia. Don't worry about your piling up. I will not check it, strike it right now, but I could well do it. So in Australia there is an amount as large as $712.7 billion, which are divided in 597.2 billion in equities, 106.3 billion in long-term debt, and 9 billion in short-term debt. What this means? It means exactly as what you're reading. So the Australian people, they are invest for 597 billion in US stocks. The Australian government or banks in Australia or subsidiaries of American banks in Australia, they hold a stock of 106 billion in long-term debt, which is US Treasuries, and short-term debt. So, Australia, please can I have back $712.7 billion if it's possible. Belgium, $1 trillion. So it's 114.9 billion in equities. So probably it can be banks that are in Belgium, it can be banks that sold, that basically take the savings of ordinary people who ask to invest in the stock market, and they give a shitload of US stocks which are worthless. So there are $114.9 invest in US equities. There is a holding of 911 billion 900 billion in US Treasuries, which can be as well in banks, can be American banks, can be European banks, it can be in the central bank, and 53.4 billion in short-term debt. And so you can see here another fancy thing, Bermuda. You know, when you go to the seaside, you want to wear your nice shorts, your knickers, and you want to swim and have a nice pina colada. So there are 404 billion in the Bermudas, and it's 134.5 billion in stocks, 227.7 billion of treasuries, long-term treasuries, and 42.5 billion in short-term paper. So you probably you start to see something. Okay, they want to give us tariffs. Yeah, okay, so what about all these people who have all this money stuck in the Bermuda offshore? They don't pay a penny worth of tax. So the United States government knows exactly where it could find money. Cayman Island. Let's have a look. 2.7 trillion stuck in the Cayman Island. 1.86 trillion in equities, 721 billion in long-term debt, 144.2 billion in short-term debt. So all this money which is parked in the Cayman Islands, which is dollars, yeah, US dollars, and it's $2.7 trillion which is allocated in equities. I don't know, I mean, the Cayman Island, how many people do live in the Cayman Island? 5,000 people? 10,000 people? You know, I never heard of such systemic, large global bank that has 2.7 trillion in assets and it's located in the Cayman Islands. So there is something dodgy here, something really, really stinky that stinks to high heaven as the manure of devil. And, you know, you could find a lot of tax money here between Bermuda and the Cayman Island. There is 400 billion here, 2.7 trillion here, and these are the data that are available at the Treasury Department of the United States. So these are supposed to be the official data, quote unquote. So there is, we could actually say to the United States, first of all, we would like to have our $31.2 trillion back. Second, we would like to collect some taxes from these offshore tax havens, because there are maybe, I don't know, American banks, there are Asian investors, Middle East investors, European investors, South American investors who park their money in the Cayman Island, in Bermuda, in the British Virgin Islands, 260 almost billion dollars parked in the British Virgin Islands. So we would like to know who these people are, and if and when they ever paid a penny of tax to the jurisdiction in where they reside fiscally. Okay, so the IRS does nothing, and US government says, okay, we're gonna put 25% tariffs on champagne. Yeah, you know what? Fuck all. I don't give a damn, because if you want tax money, they're all here, and they don't do it on purpose. They fire teachers, they fire, I don't know, whoever works for the government for just, you know, ruin the life of ordinary people, and there are money stuffed all over the world. So, you know, Donald, we would like to have $31.2 trillion back of our money, alright? Otherwise what? What you gonna do? Yeah, we'll see. So, $2.7 trillion in the Cayman Island. Okay, equities, debt, so all this money is parked there, and it's yielding a fortune to offshore companies. And then, you know, all the tricks that used JP Morgan, Goldman Sachs, and then UBS, they open these offshore accounts, and nobody knows who is the trustee. So it's a question of trust, and the world could well lose trust in the United States. The global community of peaceful nations could well soon lose trust in the United States government and the US Treasuries, because, you know, there is an outstanding $12.9 trillion of US Treasuries which is spread around the world. And, you know, we could start to question, are you able to pay us back, or you keep pretending to roll over all this debt without us noticing anything, you know? And if, for example, we say, okay, no worries, we don't need US soldiers here, we send all the US soldiers back, are you going to have a few million people unemployed in the United States? I think so. So if we don't buy United States weapons, which are F-35s and something like that, and we don't put money into NATO, actually you're gonna have a lot of people unemployed, because we can say, okay, we don't need these soldiers, we are peaceful people, okay, we are not gonna buy F-35s anymore. So what you gonna do? What you gonna say? You're gonna have a lot of people coming back into the United States, American citizens, which will be unemployed, you know? And all these people who live here in our countries, they are very welcome. They are our brothers and sisters. We are elated to have them here. But I don't think the United States pays a penny for the bases. All the barracks and infrastructures, you know, they are all paid by the taxpayers in the country where is the NATO base. So if you have a NATO base in the United Kingdom, or you have a NATO base in the Netherlands, the United States government doesn't pay a penny for all the infrastructure. It's the Netherlands government that pays for that. So it's just free for all. Okay, so there are quite a few things. You want to put 20%, 25%, just do it. Then we would like to have $31.2 trillion of our money back. And there are 2.3 trillion here in Luxembourg, of which 1.2 trillion dollars it's all in equities. So all your banks and stuff, their money there without paying a penny of tax. 978 billion of treasuries, long term, 150 billion short term paper. We are stuffed with this stuff, which is worthless, basically. It's totally worthless. So if and when, and I think soon, there could be a reckoning and a loss of trust in the treasury market and the overall reasonability of the United States government, then why not? Why we should not sell treasuries? We want to get rid of US treasuries because it suddenly becomes risky to have all this paper, which we don't know what the United States government could actually do. So why we should hold all of these treasuries? For what reason? If these financial assets, they become risky, like Japan, 1.5 trillion in treasuries. They are heavily invested in United States products, which is stocks or bonds. $2.5 trillion Japanese have flooded the United States with money. Okay, and then you say, oh, I don't want to have a Toyota. You need to build the Toyota plant in my country, which is not your country. You don't own a penny worth of nothing. So I think this is the reality, and ordinary people, they must know this stuff. And the Americans, few Americans, they forgot how much money we give them. Again, 31.2 trillion. It's almost $17 trillion which are invested in the stock market, in equities, in all sorts of forms. 12.9 trillion in long-term treasuries, and 1.3 trillion in short-term debt. So the United States, on top of that, we give them whatever they like: food, cars, perfume, foie gras, caviar, champagne, and it's on the never, because the exporter has to provide a letter of credit for the importer to import the goods. So it's not a given that an American importer of goods, he pays pronto, like cash, immediately. In the open market, in the trade between countries, there are letters of credit. So the exporter often provides credit for the importer to pay some goods with 30, 60, 90 days delay, if ever necessary. So we will give you the goods, we give you the money. What you give us back? Nothing. Worthless paper, which are stocks, certificates, bonds, treasuries. If you have 120, 130% of debt to GDP, I don't think the treasuries, they are really a safe investment. I don't want to hold that. I mean, Japan, they could well sell 500 billion of treasuries. They don't want it. They don't want to have it. So, I mean, the reality is that the entire global economy has forked a humongous amount of money to prop up the United States. China, $1.4 trillion. And the most improbable, Denmark, $266 billion. Again, France, $884 billion. Germany, $700 billion. Hong Kong, $500 billion. You could say, oh, well, this is the United States that throws money around. No, I think it's investors in those countries who have spent a lot of money to prop up the United States. All the savings that are for the United States to have so large deficits, fiscal deficit, trade deficits, there must be some savers globally who take their money and flow their funds to balance the deficits that the United States runs. And so the United States takes goods and they give us worthless paper, which are stocks or bonds, and the dollar, which is a worthless currency. So I think this is abundantly clear. Like Norway, the largest sovereign wealth fund, $900 billion of investments in US financial assets, $688 billion only stocks. And Norway sovereign wealth fund, they are exposed to a Ponzi scheme and they are reckless. But this for what? For kindness, for considering the United States like a friendly country. You want to put tariff, but then we will see what will happen. I don't think this will be pleasant. In any way, it won't be pleasant. We are ready for anything, any sort of scenario. Saudi Arabia, 367 billion between stocks and bonds. Singapore, 876 billion. So these are in Switzerland. There is 1.2 trillion dollars with 792 billion only in stocks. And we know that the Swiss National Bank has on its balance sheet, the Central Bank of Switzerland has on its balance sheet stocks. They buy stocks, which is ridiculous. So we are like between Norway and Switzerland, they are tying taxpayer money to a Ponzi scheme of the stock market, which is reckless. And nobody says anything. In Taiwan, 776 billions. And so the whole world is in credit with the United States for $31.2 trillion, which if we want to take it, demand it as cash now, I don't think the United States is a solvent entity. To me, it's not an entity at all. I live perfectly without the United States. I can do very well without. I don't need anything that it's American, honestly. So with more precision, we can see here the largest foreign holders of Treasury securities. So as of January 2025, this is the latest data. In Japan, there is 1 trillion of US Treasuries. In mainland China, there are 760 billion. In the United Kingdom, there are 740 billions, and these are all part in the subsidiaries of Goldman Sachs, State Street, JP Morgan, and all the US banks that have their branches in the city of London and in Canary Wharf. They are all staffed with US Treasuries, and probably some, also the UK banks, they must have some US Treasury as a collateral. But if suddenly there is a loss of trust in the United States, there can be a crisis. Like countries, they could start to sell treasuries because they don't trust the United States as an entity. So it's very, very risky, and there is the risk that this can happen. It's a scenario that it's possible. There are so many billions, thousands of billions of trillions of treasuries globally that, at some point, maybe investors say, I don't want to hold that security because it's too risky. There are too many risks, which are financial risks and which are geopolitical risks, and I don't want to have anything to do with that. It's a perfect free choice that anybody can have. Again, Cayman Island, 404 billion, and Luxembourg, 409 billion, just tax-free. 800 billion of treasuries, which are accruing billions in coupons, which are tax-free. And then some nutter in the nut house in Washington, D.C. comes up and says, they want to put taxes on, I don't know, Google or Facebook, which are in Ireland, and they pay 12%. Its headline corporate tax is 12%. The effective rate of corporate tax is between 5 or 7%, while there is $400 billion in treasuries parked in the Cayman Island, which are not taxed at all. I don't think in Switzerland that there is this great taxation. In Ireland, there is this huge tax levels on financial assets, and on Luxembourg, it's total anonymity or funds which are there, which are all US banks or US funds mostly, but they don't pay a penny of tax. They don't pay a penny of tax whatsoever. So, I mean, this is the reality. These are the amounts which are in the global economy, in the global financial system. Japan is creditor just only for treasuries for $1 trillion treasuries, $1 trillion, and the total liabilities outstanding, which are owned by the United States, owed by the United States, it's around $8.5 trillion, which is about 28% of the total stock of US debt, US public debt. And this percentage has declined from 35% to 28 point something percent. So a little bit more than 28% of the whole United States public debt, which is, I don't know, north of $30 trillion, it's in the hands of foreign investors. So the whole world, it's a creditor, it's a large creditor to the United States fiscal deficits. And, you know, we cannot take that sorts of unreasonable diplomacy from the United States. Because then what happens after that, you get answers like this, you know, and then we don't give a damn. What you gonna do? We will see. We are prepared for anything, and the rest of the world, we can just dump US financial assets, and there is no problem. There is no problem for us. We'll take a hit, but I don't think the United States will come out unscathed. And these are other data, and there is a specific. There are specific. You see columns here, and says treasuries. Then there are agency ABS, which are asset-backed securities. These are other sorts of credit derivatives, corporate asset-backed securities, and these are corporate bonds. So there are the 5 categories of debt which are spread around the world, which are owned by all foreign investors, or which can be subsidiaries of United States financial institution in other countries of the world. But we see that the total amount, as we saw before, it's $12.9 trillion of the total debt, and the overall stack of debt, it's made by treasuries, agency asset-backed securities. It can well be ABS, but it can well be mortgage-backed securities. So there are these packaged subprime mortgage-backed securities, which billions and billions of dollars, which are spread across countries. This agency non-ABS, these are the securitization of subordinate debt, which it's auto loans, credit cards, consumer loans, and we see that the Americans, they don't shy of giving this shit worthless credit derivatives to other investors. Then there is this corporate ABS, so these are other credit derivatives, debt derivatives, which are securitized of the corporate bonds issuance. So it can be Apple's, Goldman Sachs, whatever. What exactly can be whatever, because it's corporate issuance. And corporate non-ABS, because this is not credit derivatives, these are the outstanding corporate bonds to which all the other countries are allocated and are exposed to. So this big amount here of 616 billions, it's corporate bonds which are located in Belgium. So there are probably foreign investors which heavily invest in corporate bonds, United States corporate bonds. It can be United States banks which are dealing in other American companies which issue corporate bonds. But as you can see, the exposure worldwide, it's huge. Like Canada, they extended $730 billion in credit to the United States, which they should demand back, and the United States could well pay Canada $339.5 billion in treasuries. Canada is exposed for $156 billion in asset-backed securities, mortgage-backed securities, and they have a very large exposure of almost $200 billion in corporate debt and $33.5 billion in the corporate asset-backed securities. So Canada is very generous countries. You know, they allowed people to go in and out of the borders. They allowed goods to move in and out of the borders. And at the same time, Canada has forked $730 billion of Canadian people's savings to the United States economy. And partly the most part, it comes from the Canadian banking systems like BMO. They are every day parroting around, buy US stocks, buy this, buy the other. So, you know, they basically rip off Canadian savers and they take Canadian dollars and they give them United States stocks, which basically it's a Ponzi scheme. And again, Cayman Island, there are $721 billion which are divided between treasuries and corporate bonds. So we see that $433.8 billion in corporate bonds, they are hidden in the Cayman Island, and evidently the American multinationals, they issue this debt and they stuck it in the Cayman Island, and they don't want to pay taxes on this debt, even though they could use the interest rate tax shield for deducting the interest rate cost from the corporate tax rate. But these are very, very dodgy things, which are they stink to high heaven as evil manure. And China, even the Chinese, they are exposed for $1 trillion to the United States. They've been very, very generous. They've given a lot of money to the United States. Nevertheless, maybe there are American banks in China that do business, they hold this liquidity, but again, the whole world is in credit towards the United States. So it's actually the United States that owes a lot of money to the rest of the world. Otherwise, it's not possible that the United States and American citizens can have the lifestyle that they enjoy. They can have so high wages, they can import so many goods and services, and the United States government can run a fiscal deficit, ballooning the fiscal deficit for decades, and ballooning trade deficits for decades. So all the deficits on which the United States Ponzi scheme economy works, they are all funded by savings from the whole global population. We are a little bit more than 7 billion people, Donald. If you have a problem with us, you better worry. You better be worried. Because we are ready to anything, any scenario. And we are a little bit more than 7 billion people. And we ain't gonna be scared by a few idiots in the nut house in Washington, D.C. So, Luxembourg, 978 billions. United Kingdom, $1.2 trillion, which are stuffed there, managed by US banks and UK banks and whoever still does business in the City of London, which is another Ponzi scheme, because the British, they well thought to create this wonderful parallel market, the CFD, another biggest fraud, global fraud. Okay, so, you know, you all cover your asses without any sort of shame. And I've carried out my research and I've tried to simulate the theoretical impact of what could be a global sell-off in treasury market, if and when there could be, I think there can be a loss of trust, a complete loss of trust in the US treasury market. And I have a few simulations which are just machine simulation, But we can see that according to 10, 25 or 40% of treasury sell-off, the, the, you, there are immediate effects on the dollar index, and there are immediate effects on the, here I have just used the 10-year treasury, which is the most known benchmark, and it was very cumbersome to have the whole treasury yield curve. I couldn't give them, but anyway, there could be between 100 to 200 basis points steepening of the 10-year treasury yield. So the whole scenario, it's it can be basically defined with a simulation. But for example, only in real numbers, only considering these 5 countries where there are the largest, the first 5 countries, the first 5 largest creditors of the United States, if there is a sell-off of 25%, the 10-year, it's likely to jump by 127 basis points. The dollar index, it could go down by decreasing value by minus 10%, and you can see here the amount projected sales. Like Japan would shed $270 billion in treasuries. The Chinese can shed 190 billions. But the United Kingdom economy, I'm not sure about the data, because it doesn't consider who owns the treasuries. I don't think they are only UK banks, they are mainly American banks. Again, Luxembourg, it could be again the same thing. Also, there are European banks, probably European funds, which hold US treasuries. So I mean, the scale of the magnitude of a theoretical scenario of 25% sell-off for the whole outstanding amount of 3+ trillion of treasuries, which are parked with foreign in other countries which are creditors to the United States. The overall amount here it's something around $848 billion. So these are very large amounts, because the United States has issued so much debt. It's a country which is so much in debt, and it's very risky to I mean, in normal times it's not so risky to be exposed in treasuries, but there is so much money outstanding in financial markets, which are US treasuries, that even if we consider a 10% sell-off scenario, you are talking about hundreds of billions of dollars of treasuries which can be dumped in the market in a very rapid pace, and that would be a huge financial market dislocation for the treasury market, the yield curve, and the Federal Reserve, which would not know where to how to handle the situation. I mean, I'm not saying it's going to happen tomorrow, but it's a question of trust. If the global community and the whole countries which are creditors to the United States, they start not to trust the United States as in all its dimensions, as an economic partner, not a partner, as a viable country to have fair, free trade, and also on the geopolitical side, and on the diplomatic level, and in all sorts of dimensions, then there is a loss of trust, and there could be financial consequences. That, I mean, countries which are so heavily exposed to US treasuries, they could well decide, okay, I don't want to wait, I don't want to hold to maturity all this debt. It's better I will sell in the market, realize to cash treasuries, because I don't know which direction the United States is taking, and we don't know the future, but the bend of the curve probably, if doesn't bode well, countries and foreign investors, they can become very, very skittish, and they say, okay, even if I'm holding treasuries, I want nothing to do with that, and I want to start to realize cash, because I'm not convinced I'm losing trust. I'm losing trust. And there is a loss of trust and a loss of confidence in the treasury market, and whole there is the reliability of the United States, then the ripple effect can be very large. Hundreds of billions of dollars. So treasuries can be sold at a whim in the market. And here there is also the derivative effect, like mortgage rates, they can spike up 100 basis points, corporate debt can spike up 140 basis points, and you can have an inflation impact, and there are some other factors which can be export growth, import cost, there are a lot of variables. You can have more exports, but I don't know what gonna happen to credit spreads, to mortgage rates, to corporate debt. It would be very, very stressful indeed. And I also have some other kind of simulation which are very, very contained, because it brings only a 5% treasury yield. I don't think so. I think that the magnitude of the steepening and volatility in the treasury market, when you can see that these are results which are out of the ordinary. Treasury yield 19.34%. Of course, these are simulation, but just to give an idea, if you basically just do a linear reaction function, and for as much as the amount in US dollars sold in the market of treasuries, it's 800 billion or 1.6 trillion, 2.4, 3.2 trillion, then the steepening of the 5-year, 10-year or 30-year yield in the treasury is without any any sort of possible real benchmark. But I mean, just $800 billion in a linear fashion, considering in proportion amount of dollars to basis points, then the 5-year treasury will be 20% yield. It's ginormous. I mean, of course, these are all simulations, so but the magnitude of the shock, it's let's say unquantifiable at the minute. But again, when there is loss of confidence and the loss of trust, then investors, they start to change their attitude, and they probably say, okay, I don't want to hold treasuries because it's too risky. And there are other sort of VAR parameters, like Japan would sell $16.7 billion, or the VAR 99, it would take a $23.7 billion loss on their overall holding of treasuries, which is $1 trillion. So in a forced sell-off, then of course, when you are holding so large amount of treasuries, then you have write-off of you're going to take some losses, which can be 16 to $23 billion or 10-12 billion dollars, some very large amounts. So this would take a considerable loss of confidence in the treasury market, and what basically are the underpinning features of stability, or criteria of stability of the treasury markets, which are many dimensions. And these are the top 15 countries holding treasuries, 95 confidence percent interval. So it's the value at risk confidence interval, and basically what would be the theoretical loss on the overall amount of treasuries that these countries are holding. And that's another very fancy chart, but nevertheless Japan would have to fork the largest loss. Japan and China, they will have to fork the largest loss, that can be 12, 16, 23, 24 billion dollars on very large amounts, which are 700 to up to $1 trillion in treasuries. So overall, risk metrics, volatility. I mean, I have as usual a lot of data. I have a much more realistic forecast of the treasury yield curve. So I want to give you some more cheerful notes because back in my previous life, I was usually a very cheerful person. I am a very cheerful person, and it takes something to make me upset. But I'm not really upset. I'm showing you what are the real data. And you see foreign portfolio holdings of US securities, so all the countries and regions in the world, and these are the portfolio holdings of US securities. It can be stocks, bonds, so the whole world, the whole global economy, including offshore tax havens, they are exposed by multiples of billions of dollars to the American economy. So the whole global economy is a net creditor to the United States, and the amounts, they are humongous. So the last total amount is 31.2 trillion. You can all find this data, and it's 16. So equities, stocks, it's $16.9 trillion. Trillion with a T, yeah? It's this one. Well, just only the debt, which can be treasury, short or long-term debt, and other sorts of debt derivatives or credit derivatives, we are approaching the 12.9 trillion, or almost 13 trillion. I think it's already well in the $13 trillion. So these are huge amounts of savings of money, which are basically extracted from the global economy and the global population, and they are flooded into United States financial systems, whether it's bidding for US treasuries or it's bidding for US stocks. And it's $31.2 trillion. So I cannot deny that part of this money, it's probably US banks that they work within the United States financial system, the dollar system, but most of this, they are savings of the whole global community. 7+ billion people, which are savings in US dollars, or countries that hold US treasuries as the most liquid collateral, banks, global banks which hold US treasuries, portfolios, investment portfolios, and all the savers from the top 1% to the last shoe shiner, which holds some savings or ETFs in US stocks. So the whole global population, it gives everything to the United States. It gives money, it gives goods, it gives services, and we receive worthless paper, which is a Ponzi scheme. So the American, they give us paper which is worthless, which are stocks or bonds. It's not real money. So it's the same concept as tomorrow, like what happened in Silicon Valley. If all of a sudden all people in California or in San Diego or in wherever is Santa Monica, they go to the bank and they want to withdraw cash, then the bank does not have enough dollar notes for all the withdrawals, and the banks goes under. So if there is a loss of trust, a loss of confidence in the United States economy, in the United States, in all of its dimensions, for many reasons, also the United States attitude towards its own citizens, then if we all demand our money back, then it's a huge problem. It's a $31.2 trillion problem. Okay, so I want to be more cheerful, and I want to give you a trade. Okay, I will show you my very precise forecast of the Treasury yield curve, so that you can speculate and position in US treasuries, and probably theoretically take advantage of yields declining and the price of the treasury going up. So what do we have here? We have a yield curve modeling, which is made with Vasicek and the Cox-Ingersoll-Ross model, which is basically, it's an affine term structure, yield curve term structure modeling of yields and interest rates. So basically we have very simple parameters. We have the K parameter, the theta parameter, and the sigma parameter. So by now you should everybody knows that the sigma parameter is the volatility, the theta parameter is the expected mean value, so it's the, let's say it's the theoretical average yield, or theoretical historical volatility or historical mean, and a k parameter is the parameter that defines the speed of mean reversion. So whenever there is a lot of volatility and the yield curve deviates from the average value, which is, we see here for example the 30 days treasury notes, the last market yield was 4.37%. okay, based on the historical data from 2009, the average yield is 1.58%. okay, so the 1 month treasury starting from 2009, the 1 month treasury it's 4. We do a quick, very easy, basically I can do it by on mine, it's it will be 2.79 something percent difference that we have now. So 4.37% is the market yield minus the average 1 month T-note treasury yield in the past 35 years. No, what 35 years? 15 years, sorry, 15 years. 58, so yeah, 2.79. So there is a difference between the market yield now and what is the average yield in the past 15 years, which is 2.79%. So the K parameter tells you that the average speed of mean reversion is 0.13.5 basis points. Okay, whenever volatility goes down, there is the mean reversion trend in place within the yield curve. Okay, the same is for the CIR model, but here the K parameter is 0.5, so it tells me that basically half a basis points or half a percentage point is the average mean reversion. It's a quite large parameter, but I won't take it as very precise. I would consider much better the Vasicek model. So what do we have here? That the average standard deviation is between 1 and 1.8 sigma for the 1 month treasury. The historical volatility has been 1.8%, and the theta parameter is 1.8. Okay, so the average mean value, expected mean value of the 1 month yield for the treasury, it's 1.8. So if we go and see the chart, we can see basically that the machine gives us a forecast. It tells us, okay, the current yield is 4.37%, and the 1 year forecast is 4.10 plus or minus 0.06, and even the CIR model goes much further, and the 1 year forecast is 3%. So the red line, of course, is the CIR model, and you can appreciate that the shaded area is larger. The uncertainty in the model, the range, it's larger than the blue line. So the Vasicek model is more precise, is less downward sloping, but nevertheless, what the main takeaway, the main concept, the easiest thing to understand is that based on the past historical data that start from 2009 up to the 27th of March, past Friday, the yield of the 1 month treasury should decline, and this is perfectly in line with the theoretical idea that the Federal Reserve will cut the SOFR rate, even whatever, considering inflation. Let's put aside all that stuff. So if you want to do an investment, you can buy, for example, short-term paper, and you can expect that the yield here goes down by 0.27%, and by knowing exactly the modified duration, and for every basis point how many dollars how many cents or dollar the price of the 1 month treasury increases, then you can basically arbitrage your investment, and you know exactly what is the carry and what you are going to gain with a lot of precision. It depends what you want to take. You want to take 4.4% or 3%, you can evaluate both the scenarios and have a precise idea what is the gain in investing on US Treasuries, and expecting what is the capital gain, expecting that the yield will decrease, unless there are some other scenarios such as a loss of confidence and a loss of trust in the treasury market, or a sudden unexpected increase and rise up in inflation, which can be stoked by tariffs or supply chain frictions and all sorts of other exogenous variables that will keep inflation at higher levels. So I would be more would be more comfortable with the Vasicek model, which tells me, okay, yields in the next 6 to 12 months will go to 4% rather than 3%. But if you think at Q1 2026, Q2 2026, maybe you can, fingers crossed, you can hope that basically the Federal Reserve would set the federal funds rates at 3%. So, but the 1 month duration is not 1 year duration. So let's see what is the 1 year. So duration by duration, the machine gives you all the parameters. You know what is the kappa parameter, what is the volatility, what is the mean parameter, the theta parameter, which is the expected theta parameter of the historical mean value of, you see the 3 months is 4.33, the historical average in the past 15 years has been 1.64, but with that you have to consider 1.8 of average volatility. Okay, so the 1 year, which is a good proxy for monetary policy, the historical average is 1.8, the current yield is 4%, and the expected theta parameter is 2.25. So we can theoretically expect something around 2.25 or 3%. Let's see the forecast summary for 1 year. Okay, so there is not much variability, so I can appreciate that the parameters of the model, they are quite consistent, and they don't deviate too much from where the yield curve is actually now priced in the markets. So the 1 year forecast tells me, okay, the current yield is 4.1, 1 year time it expects 3.994% plus or minus 0.04. So while instead the CIR model does a completely different work, it tells me, okay, you can expect a range of, you can all see what is the range, it's between 3 and 3.27%, so 3.25%. So if we want to guide ourselves to the proceeding further theoretical possible future path of the Federal Reserve fund rate, we can presume, being very arrogant, that within 1 year the Federal Reserve could be between 3 and 3.25%, 3.25%. Okay, so I can buy a 1 year treasury today, and the price, we'll try to tell you the price in a minute, because I also have the convexity. It will be probably a little bit below par, sort of, a little bit less than $100 in the market price. And then I can expect, by calculating the modified duration, I know that for 100 basis points arbitrage between now and the maturity of the 1 year treasury, I will have a specific amount of capital gain on the bond price. So this is how to theoretically implement some interest rates model, trying to forecast what is the path of interest rates going forward, and then you can build some sort of bond portfolio arbitrage, like the market price for the 1-year treasury. It's supposed to be something around 98. Sorry, this is too large. No, I need this. $98.9. Okay, about $99. Okay, the market value vis-a-vis the face value, it's $100. Okay, so you would theoretically buy at a discount the 1-year treasury. Then you can apply the modified duration and see what is the theoretical 1-year treasury price when the bond goes to maturity, and you can calculate the gain when, if and when the yield will go from 4% from the market yield now to 3.1, 3.2%. Okay, expecting that the Federal Reserve would slowly cut interest rate, although it's not a certainty because we don't know what is the future path of monetary policy. But monetary policy in isolation is predictable. You do a forecast model, you can predict what is the path of interest rate, and you can confront many models. But what are the exogenous variables, which can be inflation, supply chains, the nut house in Washington DC, and so forth and so on? Then there are a lot of unknowns, and so that makes difficult the job of a bond portfolio manager. But then you can manage the 1-year treasury using some put options, so forth and so on, but that makes it more complicated. But nevertheless, all this would theoretically offer the opportunity of a arbitrage. If you lock in the man in the nut house and you lock him in, lock him up, then you can go long the the 2-year or the 1-year treasury, and you can expect, for example, for the 2-year treasury, you can expect an arbitrage of 100 basis points. For the Vasicek model, you can expect an arbitrage of 20 basis points, which is much more conservative estimates, less volatile, but nevertheless it's credible. Believe you me, it's credible, because inflation, it's by no means a solved enigma. But if basically the 2-year treasury goes from 4% to 3%, then you have 100 basis points carry, which is not, you are still earning the coupon, which is paid by the 2-year treasury, but then you have 100 basis points discount in the yield, which translates in a capital gain. And the 2-year treasury, for example, dirty price in the market, it's $98.15. So it's sold at a discount vis-a-vis the $100 par value. So you can buy at $98.15 and basically you bring it to maturity at $100. So you are pocketing theoretically $1.85 gain, which are, I think, theoretical quasi-sure arbitrage gain, and very simple thing. But if you want to argue that the bond market price is $98 and you hold it to maturity, and you know that the yield is gonna go from 4% to 3%, and you will sell at parity, you will be reimbursed at parity at $100, then this is a net sure arbitrage of $1.85 for every bond of every 2-year treasury that you will stuff in your portfolio. And at the same time, probably you will have a very nice coupon, which will not be the same when the 2-year treasury will be rolled over again in 2 years time. So there are a lot of consideration. I have to love you and leave you, and just be aware that it's all well and good. Treasuries yield are, according to my models, they are projected to decrease in the next year or so, and this can offer some sort of technical arbitrage in the market. What we can appreciate is that, for example, when the duration of the treasury goes, for example, we see here, these are the charts that start from the 5-year treasury. So we are considering the medium term duration to longer term duration. We see that the spread of the forecast between the Vasicek and the CIR model, it narrows. And here, yeah, we see that the longer is the duration, here for the 20-year treasury, the forecast is pretty much similar. And basically, this brings some other concept that the longer duration treasuries, they are mostly correlated to each other, like the 5-year, especially the 7-year, the 10-year, the 20 and 30-year, they are very much correlated in the slope of the curve and what are the yield levels. So I have other models. If I run the OLS regression, I see that for every time that the 7-year basically goes up by 1 unit, I have a substantive significant change in the 10-year yield. So these are very much correlated, and so the forecast model, it tends to not have so much large spread between the two kind of interest rate term structure models. So 5-year yield, let's see. Yeah, there is no much difference. The Vasicek model is 3.68. The yield now it's 4.10%, and the projection is about between 40 to 70 basis points of decrease in the yield. And this is very, of course, this is very mechanically possible, because you want to expect a positive sloping yield curve, like a normally sloping yield curve. So because the treasury yield curve is pretty much flat, the treasury yield curve as in the market now, it's pretty much flat around 4. It's slightly inverted between the front end of the yield curve and the belly of the curve, and then the long-term yields, long-term duration, they are most in line with the Fed fund rate. So what you want to expect is that when the Fed cuts, the front end flattens more. I mean, the slope, it basically goes downwards. The slope changes to this kind of scenario. Convexity, which is much more subdued in the front end of the curve, and you have a positive. So it's to make it simple, it's normal that the 6-month or 2-year, they have 100 basis points, 100 bps decrease in the yield going forward, and here the 5-year has a range between 40 to 70 basis points of decrease. So the belly of the curve is supposed to change its slope. The derivative change of the slope of the curve in the medium duration is less. The rate of change is less in basis points considered vis-a-vis the front end of the curve here. So you want the front end will go down much more, so that you have a normally convex yield curve. So in this, the model gives out some realistic yield curve change. The derivative change of the slope of the yield curve, it's less and less the longer is the duration of the debt security, because the front end of the curve, of course, it's much more responsive, is directly set by the Federal Reserve, while the treasury market, it's in the open market, so it's the yield, it's by supply and demand of bonds. 10-year forecast 4.38. The Vasicek model brings a 4% 10-year yield. The CIR, it's 50 basis points, so you will be gaining 50 basis points of yield vis-a-vis the price of the 10-year treasury. But in the graph, you see that the differential between the two models is very, very minimal. We are talking about 10 basis points. That's it. And what is nice is the plus or minus the expected shortfall of what could be the yield. And we see here the K parameter, it's much larger. It's 0.35 basis points. So it means that whenever the yield curve moves, the 10-year yield moves, then the average, the speed of mean reversion, it's on average 0.35%, okay, while, which is this parameter here, 0.34, 35. The speed of mean reversion of the 1-year yield is 0.05. It's much less, okay. So there is, we see that there is less sensitivity in the short-term paper. There is more sensitivity to volatility and to the slope of the yield curve in longer duration, in medium to longer duration debt securities. These are the characteristics of bonds, and basically the yield curve is very sensitive to what are the levels and to the slope of the yield curve. So the longer is the duration, the more it's sensitive to change to volatility in interest rate and to what is the slope of the curve, okay. Yeah, and the 20-year Treasury, very small change, like 20 basis points, so there is not much room for arbitrage. The 7-year probably can offer some more sort of arbitrage here, because 4.23 is the yield, the market yield. The forecast is for 3.85, 3.8, so it's again about 30, 40 basis points of yield downward slope in the yield, and that would be a capital gain on the price of the US Treasury. And we are complete for now, so I to love you and leave you, and just if we can have our $31.2 trillion back, I think the rest of the world will have much larger disposable income. They will have a lot of savings, and our living standards will just become much better all of a sudden. So people who live in glass houses, they should not throw stones.